guess we good, right? So let's continue with partnership. Before we go on solving the question for today, I want to do a bit of explanation with okay. I was in lectures on Friday, and there's a bit of confusion in my class on how the Google is treated. I don't know if the same confusion happened in the other classes. So I want to spend some 5 to 10 minutes to explain how the Google is treated, specifically the two methods of treating the Google, the memorandum method and the purchase and sale method of treating the Google. Okay. I'm going to make the assumption that we will all do the reading, i.e. what is goodwill, the lawyer's definition of goodwill, the accountant's definition of goodwill. We will read that. We will also read the circumstances under which goodwill will be brought into the books. Okay? About 5 or 6 circumstances. I want us to read that as well. The reason I want to speak that is because those are reading and we can read and understand so that we can focus on the arithmetic. Okay. I'll also speak the zoological classification of goodwill. Okay. So if you look in the textbook, goodwill is classified into 4 or 5 different types. And the basis of the classification is rooted in zoology, meaning the concept of animals, right? Use the concept of animals. Because the goodwill behaves in a certain way, and the way the goodwill behaves is similar to the way certain animals behave. And that's why we do the zoological classification of goodwill. So for example, there is the cat goodwill, there's the dog goodwill. When we say dog, I mean, how do dogs behave? Dogs are attached to their master or to their owner. They go wherever the master goes or wherever the owner goes. We agree. That's how dogs behave. And when we say dog goodwill, it means this goodwill follows the business. Wherever the business goes, that goodwill goes with it. Okay? When we say cat goodwill, we're talking about, you know how cats behave, right? They are attached to the house, right? So the owner of the house can leave, but the cat is still remain in the house, right? So there's that goodwill that stays where the business is at. So when the owners move, the goodwill will not move here. The goodwill will stay where the business is at. So that goodwill is as a result of where the business is at. So it hasn't moved. Okay, that's the same cat goodwill. There's the rabbit goodwill, there's the rat goodwill. We all mimic those animals, right? So I'll need us to read that. Now, I will start from how goodwill is valued. Okay? There are different methods of valuing goodwill. Up to this point, you know what goodwill is. You know what it is. But how do we put a number of goodwill? How do we say goodwill is 10,000 or goodwill is 20,000 or 100,000? What is the basis for valuing goodwill? There are different methods. And there's something that will always tell you. Okay? Or maybe you may ask in the theory, give 3 or 4 or 5 different bases of valuing goodwill. If that's the case, if you have it, if you are ready from the books, right? So one is, for example, we can value goodwill based on an average of sales. So the examiner, for example, will say that goodwill is valued as 3 times the weekly sales. 3 times the weekly sales. In which case, the examiner will have given us, for example, the examiner will give us an annual sales. Okay? At let's say 100,000. it gives us annual sales of 100,000. Then it says goodwill is valued at 5 times weekly sales. 5 times weekly sales. Okay. So it says goodwill equals 5 times weekly sales. Right? He's already given us the annual sales. From this, we can find the weekly sales, right? Because it says average, right? 5 times average weekly sales. So your weekly sales is what? 100,000 divided by what? 52. So there are 52 weeks in a year. Okay, so if the whole year we made a sale of 100,000, then on average, a week sale will be 100,000 divided by 52. Okay. What do we get to a certain number? What do we get? Sorry. 1923. So this is the weekly sales, right? Now the number says goodwill is valued at 5 times the average weekly sales. So in this case, our goodwill is going to be 5 times 1923. Are we okay? There are 52 weeks in a year, right? So if you want to find how much sales was made in a week, we will divide the total sales in a year by 52 to arrive at the weekly sales, right? Once we know our weekly sales, we multiply that by 5 because the example says goodwill is 5 times weekly sales. Are we okay? Alright. So this is just one approach, 5 times weekly sales. There's someone who says 3 times the annual sales. We could say a month's sale. There are various ways of determining it, right? But there's someone who always tells. Now, once we establish the goodwill, that's where it gets more interesting. Okay. So now goodwill has been established, right? Or calculated. Okay. Goodwill has been calculated. There are 2 things that we have. First of all, we recognize the goodwill. Right. Then the examiner may either say that the partners wish to keep the goodwill in the books, or they do not want to keep the goodwill in the books. Are we on the same page? So either they want to keep the goodwill in the books or they do not. But once we calculate the goodwill, if the partners want to keep goodwill, or do not, or don't want to keep goodwill. Okay. If they want to keep the goodwill in the books, then you can only have one approach, which is the memorandum method. And I'll explain what it is and how it works, right? But I just wanted to have this graphical picture. Okay. Now, if they do not want to keep the goodwill in the books, then you can have one of 2 methods. Either the memorandum method or we are good up to this point. Okay. So what you need to remember is that the memorandum method can be used in either case, right? Whether the partners want to keep goodwill or do not want to keep goodwill, the memorandum method can be used. However, if they are keeping goodwill in the books, you cannot use the sale and purchase method. You can only use the memorandum method. Okay? And you will do both, so you will appreciate the difference, right? Now, this method is a bit confusing. Okay? So, a lot of the times, the examiner will not restrict you to using this method. A lot of the time, they will not. However, we don't know which examiner will show up for us. Because for some examiners, they are comfortable with it or they want to test this side. So he will specifically say, use this approach. So we will have no choice but to use it if we want to solve the goodwill question. Okay? So we'll have to take our time and explain it. Alright. Any question up to this point before I move? We good? Yes. All good. Alright, so we'll start with the memorandum method. Right? And I'll do the memorandum method for both keeping goodwill in the books. I'm going to demonstrate the memorandum method for both keeping goodwill in the books and do not keep goodwill in the books. Right? Then when I'm done, I'll shift to the sale and purchase method, which is strictly for not keeping goodwill in the books. So please remember when the examiner says, hello? Okay. So when the examiner says the partners do not want to keep goodwill in the books, you should know you can use two methods. Okay. Yes. Can I write? So, can you all hear me? Those at the back, can you hear me? Can you hear me? You can hear me now. I'll try and shout. So, So first of all, the examiner will give us the basis for calculating the goodwill, which is what we started with, maybe 5 times average sales or whatever it is. So we established the goodwill to be 10,000. Okay, we have calculated the goodwill as 10,000. So that's what we are writing. What we need to learn is how to record under the two approaches. Goodwill is an asset, just like any other asset. The only difference between goodwill and all other assets, goodwill is an intangible asset. Other assets are tangible. Okay. So we know when you buy an asset, or you debit an asset, call it the double entry. Debit what comes into the business, or debit the receiver, and credit what goes out of the business, credit the receiver, right? So if 10,000 cedis worth of goodwill is coming into the business, what must we do? We must debit goodwill because it's an asset. goodwill is coming into the business. Are we on the same page? Okay. So we open a goodwill account. Now you will remember that we said, or among the reasons why we value goodwill and bring goodwill into the books is one, when a new partner is admitted or be proud to admitting a new partner, right? The resignation of a partner, right? We know when you buy a business, when we buy a business, or when we do business combinations like mergers, right? Mergers, acquisitions, something like buying a business. So these mergers, right? This business combination, partner count, partner growth, or when you change the profit and loss sharing ratio. Okay. These are the grounds for valuing goodwill and bringing goodwill into the business. Okay. So, for all these grounds, and that's a good thing, it's very straight, not complex. For all these grounds, when we first recognize the goodwill in the books, we only recognize it in relation to the existing partners. The existing partners. Okay? We recognize the goodwill in relation to the existing partners. So we may have 3 people in partnership. They decided to admit a 4th person into partnership. Okay? And for that reason, goodwill will be recognized. Right? Why would that be the case? That would be the case because we created some value, or the existing partners have created some value. Right? And they don't want the incoming partner to come and benefit from that value. So they want to share that value. And upon completion of the sharing, then the new partner can join them. Is that fair? I think that's fair, right? If 2 people are in partnership, they've created some reputation, which reputation is giving them some value, or is making them get some revenue. And then the 3rd partner wants to join. They want to share that value before the 3rd partner joins. So upon recognition of goodwill, we are only concerned with the partners in existence prior to the other partner coming. In the same vein, if a partner is resigning, you recognize goodwill, right? The recognition must be in respect of the existing partners before he leaves. Okay? So that I'm saying, in all these circumstances, the recognition of goodwill will be done in respect of the partners in existence at the point of recognition. Are we okay? Alright. So let's say there are 2 partners, A and B, right? And then later on C joins. Okay? All I'm saying is that the initial recognition will be in relation to the existing partners. You have nothing to do with it. Now, remember we said in partnership there are 2 accounts, main accounts that we use to record the relationship between the partners and the firm. And we said these accounts are the capital account and the current account. We remember that? Okay. And then we said the capital account, we said there are 2 methods. We have the fixed capital account method and the fluctuating capital account method, right? We said under the fixed capital account method, that's where we keep the 2. We have a capital account, we have a current account. Why do we call it fixed? We call it fixed because we want the amount of capital contribution by the partner to remain. That's why we call it fixed capital. So your capital account will be fixed. Whatever is in there will be like that. So like income support, so a new capital contribution. Now with the fluctuating capital, we said we only keep what? We keep what? Only the capital account. We don't keep the current account. So what do? we combine the entries that must go into the current account and the capital account all in one, in the capital account. We good? Alright. So, to make life easier for us, I will deal with goodwill with the assumption that we have a fixed capital account method. Okay? And I'm not waiting to say, except that when you make the entries, here, we'll be making that. Here, I'll use the thing because that's where you have two different accounts. Okay? So, and that we'll be doing this under fixed. Okay, we under fixed. Meaning we will have a capital account. Then we'll have a current account. Are we on the same page? Are we all on the same page? All right. Now back to the point I made. I said upon recognition, we recognize the goodwill only in respect of the existing partner. In this case, A and B. Okay? And we will do so in their existing profit and loss sharing ratio. Okay? Now first, let's come to the entries. So first of all, I said, remember in accounting, every transaction has two legs, a debit leg and a credit leg, right? And then we said that when we recognize goodwill is an asset, and an asset is coming into the books. So we will debit it, because we said debit what comes into the business. So we'll be debiting goodwill, right? That means automatically the corresponding entry will be what? A credit. Okay, and the question is, which of these two accounts will the corresponding entry go? And the answer is, it must go into the capital account. The question again will be, why the capital account and not the current account? Because we had explained earlier on that the capital account must be fixed. Nothing should go in. The answer is this. Remember the goodwill that we have valued and want to recognize is unrealized. Okay, we know that our firm is called Bella. We know we have a reputation. We know that reputation will bring us future revenue. No doubt about that. But is that revenue here? No, it isn't. If we put it here, this is the account that the partners come in and take money, and they come in and take money. Whatever they do, they come in and take money. If you put it here, you are likely to have a situation where they come and take money. They will be thinking that they've got money, and they are entitled to come and take it, and they will come and squander it. But this goodwill, it has not been realized. It is an intangible asset. It's an expectation of value that will be created in the future. So we need to put it at a place where the partners will not be able to touch it. They can't take it. And that is why we put it in the capital account. Remember, the capital account is fixed. Anything there you will not be allowed to take it out. The capital stays. Under company law, stated capital cannot be reduced, right? It's, even though this is not company law. The same concept. Okay. So that's why we make the entry in the capital account. Anything in the current account, profit, you can put it in the current account because the partners can come and withdraw it. It's theirs. When you pay them salary, you put it here because they can come and withdraw it. It's theirs. But the goodwill is intangible. It has not been realized, and for that reason, we will not put it here. Okay. All right. So the entry we said the recognition is based on the old profit and loss sharing ratio. So if the goodwill is 10,000, and we said, let's say these guys are sharing 1:2. Okay. And let's say when the new partner comes, it will become 1:2:3. Okay. So the existing profit and loss sharing ratio is 1:2. So we'll recognize goodwill to the existing partners in the ratio 1:2. Okay? So basically what we are saying is that A will get 1. and B will get 2, right? Meaning we are splitting the whole pie into what? 3. Because if A is getting 1 and B is getting 2, it is the total is 3, right? We're splitting the thing into 3 so that A gets 1 and B gets 2. So you split the goodwill, which is your 10,000. So if you take, let's say, A's portion, A's portion will be take the goodwill of 10,000, split it into 3, and give 1 to A. B, take the goodwill, split it into 3, and give 2 to B. You okay? So the entries to pass here is A. Okay, let me also explain this. We know when you're doing double entry, right? The description you put in this account is the header of the other corresponding account. You remember? Okay, so when you are doing an entry here, the description you will put here is the header of the corresponding account of the other account, right? So ordinarily you have dates, you have description, and you have amount. Okay, same here, dates, description, and amount. Okay, let me clean this and do this. I have space in the capital. Open partners. Okay. I'll have A, B, C, A, B, C. Natural fact, nothing stops you from opening A's capital account. Go and open another one. B's capital account. Then open the third one. C's capital. Nothing stops you. You can do that. Except that we do it this way because it's easier. And you don't save you space. You don't have to keep flipping between the pages looking for the other part accounts. It's all in one place, right? So the date of the recognition of the goodwill is the date we write, right? So let's say 1st January, whatever it is, right? I'm saying the description here will be the header of the account where we'll be doing what? The corresponding entry. So in this case, it's going to be what? Capital. And that will be capital of what? A, right? And then the corresponding entry, which will be the same date, goodwill. So the description will be that of the header of the other account, right? Goodwill. A will have 3, 3, 3, 3. B will have 6, 6, 6, 7. C will have it upon recognition. Right? Are we good up to this point? Okay. I said we're doing the situation where goodwill is kept in the books. Up to this point, we are done. We have recognized the goodwill by debiting goodwill and crediting the partners' capital account. The partners have agreed that the goodwill must stay in the books. So we will do nothing. We will just leave it in the book like this. At the end of the day, or at the end of the accounting period, we will close this account by balancing it off. We know how to balance off account. Do balance carry down, and do the totals. We are done. Then you do your balance product. So the goodwill will stay in the books. Okay? And this method is the memorandum method. That ends it. for the goodwill staying in the books. The goodwill staying in the books. In fact, 95% of the time, the examiner will prefer the goodwill not staying in the books. So this is staying in the books. Are we okay? Then I move to the goodwill not staying in the book. I'll use the same numbers to do the illustration. So, because we want the goodwill to stay in the books, C gets nothing. Now that we have established the goodwill and have shared it among the existing partners, what we will do is that we will sit down as the three of us. We will sit down and say, look, the goodwill is 10,000. So, if you want to join us as a partner, which will entitle you to enjoy in the goodwill in the future, then apart from contributing your share of capital, you also have to contribute a certain amount towards the goodwill. So we just have to make a decision regarding how much profit will you be entitled to in the future, and then make you contribute a certain amount of money towards that amount of goodwill. So for example, back to our example here, let's say 1:2:3. What we will then do is that we will say, okay, if the goodwill is 10,000, and you will be enjoying half of the profit, because 1:2:3 means that we are going to share profit into 6. And when we divide it into 6, you will take 3 of the 6, meaning you are taking half. So if that's the case, we want you to, apart from the capital contribution you bring, you must bring 5,000 into the business as goodwill. We'll ask you, assuming your capital contribution has to be 100,000. Apart from the 100,000, we will ask you to add 5,000 to it because of the goodwill. So you will contribute 105,000. But we will not write the goodwill, we will leave the goodwill as it is. So when we get to your capital contribution that you bring in, you will bring in a bigger amount than you would ordinarily have brought. But you will get clearer when we go to the next approach. All right. Can I clear so that we go on to the next? That's where it gets more interesting. Good. So, just to retrace her question so that we all hear her question. She says she understands this as being when a partner is being brought in. But what about if a partner is leaving, assuming it's A, B, and C, and then A is leaving? Right. The answer is this. We will still have recognized the goodwill the way we have done. Just like this. Okay. There were just 2 of them that were in partnership, and one decides to leave before C joins. So we'll do this. And once we do this, remember that because they were in partnership, you would have had some capital contribution from their partners. So there would have been some balance brought down on the capital, right? But once we do this, we would have established the total amount that is due him as a partner. Because he's leaving, we have to, the only time we pay a partner his capital is when he's leaving. So once we bring the goodwill into the books and add it to the capital contribution, we would have established the total amount due him. We will pay him cash by crediting bank and debiting his capital so that his capital vanishes from the book. And so his capital together with the goodwill gets out of the books. Do we follow? All right. Can I actually move on? Okay. I will leave this. Yeah, I we didn't close it because I'm going to use it to do the explanation. But otherwise, if you have to close it, just look at the end of the period, right? So at the end of the period, let's say 31st December, you then have a balance carried down. And the balance carried down will be for A and for B. And the two of them will be 3, 3, 3, 3, 6, 6, 6, 7. And this is 10,000. And then every balance carried down must be brought down. Don't forget that, right? So 1st January, the next year, you have balance brought down or brought forward, and you have A and you have B. And it will be 3, 3, 3, 3, 6, 6, 6, 7. Yes. Right. Are we okay? Are we okay? Okay. It looks like I might explain how we balance off account. So to balance off an account, here's what you do. To balance off an account, okay? Sorry. What? Let me put. All right. So to balance off the account, okay. The last I was saying, just leave enough space. Make sure you leave enough space at both sides, because you don't know where your balance carried down is going to be. So make sure you leave like two lines here before you do your total. Once you do your total, write 10,000 here, and I'll write 10,000 here. We good up to this point? But you can see that this place is 10,000, so it's fine, no problem. But this place is not 10,000. Whatever is needed to make this place 10,000 is what we call your balance carried down. Right? So that's what I have written here, balance carried down. But we know that balance belongs to two people. I mean, you can just put balance carried down 10,000 and leave it and move on. It's fine. But I just decided to break it into, because I know what the makeup of that balance is. So I just decided to break it down into the component parts. We good? Okay. The same thing here. Just leave enough space. Okay? And then you balance A with A, B with B, C with C. So I'll take column A against column A and say which side is the biggest. I'll get 3,333 here. I get 0 here. Obviously 3,333 is bigger, so I'll put that at both places. Okay? But when I look here, this is fine, perfect. But here, there's a problem. I need to add something before it tallies up. And that thing I need to add is what we call balance carried down. Are we good? And then don't forget, every balance carried down must be what? Brought down. You do same for B and B. You add column B, you get 6,667. You add column B here, you get 0. Obviously, 6,000 is bigger, so I'll put that down for both places. This is perfect. That is a problem here. I need 6,667 to balance. It is the balance carried down. Here, nothing. We okay? All right. So I'm going to switch to the more popular one, where goodwill is not kept in the books. Okay, where goodwill is not kept in the books. And I said, when goodwill is not kept in the books, that's where you have two approaches. The memorandum approach and the sale and purchase approach. Okay. We use the same one to demonstrate. So, because the numbers and everything is the same, right? I'm just going to clean this. Goodwill is not kept in the books. All right. So we said A and B are in partnership. Goodwill calculated as 10,000. We have recognized the goodwill. So this method. So I told you when goodwill is not kept, there are two methods, right? So first of all, we are going to do the memorandum. Okay. So we calculate the goodwill. We bring the goodwill into the books by debiting goodwill because it's an asset, and credit capital. First step. So the first step is the same. Remember, when we keep the goodwill in the book, I said the only method you can use was what? The memorandum method. And here to be agreeing the memorandum method first. So these entries cannot be different. Let's assume further that we agree that C will contribute, so C will contribute capital of 5,000. Let's say 15,000. Okay? And we've agreed that the new profit and loss sharing ratio is going to be this. So, first step, we recognize the goodwill using the existing profit and loss sharing ratio of the existing partners. Okay, first step. The second step is we will allow C to be admitted because now the existing partners have benefited from their capital. Okay, they have benefited. So now they can allow C to join. So what will happen? C will then pay his or her share of capital contribution, which we've agreed is 15,000. What entries will we pass? Debit bank or debit cash, because he would have given us a check or whatever it is. So he would have done a bank transfer into our bank account. So money will come into the bank account. So we'll debit bank. This is capital contribution. So what will we do? We will credit C's capital account because C has brought in capital. We agree. So let's say on the second day of January, the description will be what? Bank or cash, right? And that will be 15,000 brought in by C. The corresponding entry of this we know will be in the bank account, right? Then we are going to what? Debit bank on the 2nd of January. The description being capital. And it's what? 15,000. Are we okay? Usually the examiner will not ask for this, and you don't need to do this. I'm just doing this to demonstrate the debits and the credit. Okay? But under partnership, 99.9% of the time, the examiner will not require this. You will ask you this. Okay? So now, C has brought in capital, but the partnership firm says that they do not want to keep goodwill in the books. Meaning, when all is said and done, goodwill must be zero in the books of accounts. Okay? That's what it means. Goodwill must be zero. So all we need to do is that this goodwill that has been recognized as 10,000, that has been brought into the books, we need to write it off. We need to get it out of the books. Yeah? You need to get the goodwill out of the books. Now, to do that, you get it out by using the new profit and loss sharing ratio. Remember, they are now 3 partners. After we brought the goodwill into the books, we admitted C into partnerships. Partnership, right? So they are now 3 partners. So we cannot be relying on the old profit and loss sharing ratio anymore. To write it off from the book, we must rely on the new profit and loss sharing ratio. And that ratio we said is what? 1:2:3. Yes?
I have a challenge with the entry. So you mentioned that you credit the
partner's capital account. 15, the business money, bank, cash is coming into the business. The firm is receiving. And who is giving? A partner by name C is the giver. And the rule says credit the giver and debit the receiver. Or debit what is coming into the business and credit what is going out of the business. So we are debiting the business's bank account because we are receiving money. The business's bank account is receiving money. And we are crediting C because C is giving money. He's the giver of the money. Are you okay? Alright. So I'm saying having admitted C into partnership, the partners now agree that they do not want to keep the goodwill in the books. So what I'm saying is that what that means is that when all is said and done, the goodwill account must be 0. There must be no balance on this goodwill account. If you finish and you have a balance carried down on the goodwill account, then you are wrong. Because they do not want to keep it in the books. So it must balance. By the time you are done, this account must balance. There must be no balance carried down on it. It must balance. Abigail. Alright. So, and I'm saying that to get the goodwill out of the books, we must use the new profit and loss sharing ratio. Okay, we use the new profit and loss sharing ratio, which we have agreed is 1:2:3. So now there are 3 partners, A, B, C. So let's calculate how much each of them must be impacted as far as the goodwill is concerned. They are saying 1:3 1:2:3, meaning we're splitting the goodwill now into what? 6 portions. Agreed? 6 portions. And A will get 1 portion, B will get 2 of the 6, and C will get 3 of the 6, meaning C is getting like half, right? So basically, A is getting 1 out of the 6, B is getting 2 out of the 6, and C is getting 3 out of the 6. And it is the same goodwill. Okay, it's the same goodwill. Right? So let's calculate the numbers. What do we get? Half of this is 5,000. Right? This one will be what? Is it 3,000? 20,000 divided by 6. 18. 18.8888. Or the first one is what? 1666. I'll make it 7.
6.
And if that's the case, then it should be 3, 5, 7, 3, 2, or 3. Okay. So I'm saying we're going to pass the entry with these numbers. Now, what entries must we pass? We have an asset in the books. Goodwill. If we want this asset to vanish, the only way this asset can vanish is either we sell it or we write it off. Right? So, to get this asset to vanish, straight away you can tell that we must not be doing a debit entry. Because when you do a debit entry, you are just piling on. It's like you are acquiring more assets. Is that not so? Yes. but we've already acquired the asset. We want the asset to go back. We want to reverse that entry. We want to sell it. We want to dispose it of. We want to write it off. Okay. To write off the asset, we need to credit the asset account to cancel the debit we brought in. Does it make sense? We have an asset. Just like we have a motor vehicle. The asset is there in the books already from the initial recognition. We are saying this asset, the partners say they do not want it in their books. Get rid of it. There's only one way to get rid of it. Making an entry here. If we make an entry here, we are adding onto the assets. When you buy the asset comes in, you debit it. Right? So anytime you debit the asset, it means you said you have acquired an asset. So if you want to get rid of the asset or sell the asset, then the entry must be the credit. Okay? So pass a credit entry in Google, which then automatically means that we pass a debit in the current account. Sorry, the capital account. Remember, what that will do is to bring these balances down. But when we recognize the goodwill, we put a debit in the goodwill account and we put the corresponding credit in the partner's capital account. Give them some more capital, meaning that they have more capital. But now we're getting rid of the assets. So we must equally get rid of this. So the corresponding debit will be in the partner's current account. Okay. And so on that same day, we say 1st January, and then the description will be partners capital. Okay, and that will be A, B, C, right? Which is 1667, 3333, and 5,000. Make it 10,000. Okay. The corresponding entry will be here, and it's goodwill. And it's A is 1667, 3333, 5,000. So this credit, this is this corresponding debit. This credit, this is this corresponding debit. This credit, this is this corresponding debit. Good. Having done this, you notice that your goodwill account has balance. It's been wiped out. There's no balance on it. Okay. So this account will by itself, without a balance carried down balance. So you remember that when you did double entry, when you were extracting a trial balance, what you use in extracting a trial balance are the balance carried downs, right? So if you are to be extracting a trial balance now, because there's no balance carried down on this goodwill account, there will be no goodwill in the list of balances you will have. Because it has balance to be written on it's all. Are we okay? And then this will have a balance carried down. What you will notice is that partner A, when you balance it off, there will be some goodwill left for partner A. Because when we first brought the B and B created before C came to join, even though we are not keeping the goodwill in the post, we've written the goodwill off. He has gotten the benefit he has created. Same applies to B. Now, what will happen to C? Even though C brought in 15,000 as capital, his capital will be left with only 10,000. So he contributed 5,000 towards that goodwill that was created before he came. And when he contributed 5,000, who got it? These two guys got it. So you notice that the difference between these two and the difference between this, when you add them, you get 5,000. So it's like we've created a value of 5,000 for your account. Please pay us. You don't want to know what happened. Just give the value. And so his capital will go down. So let's do the balance carry down and you see what I'm talking about. So 31st. You are coming to balance the account, right? We just went through how to balance an account. I'll do it again so you see what I mean. Leave enough spaces and then do your totals, right? Leave enough spaces and then do your totals. Let's balance A first. So we take A against A debit against A credit, right? You check the two sides, which one is bigger, and you write the bigger one on both sides, right? I have 1,006 here and I have 3,000 here. It tells me this side is bigger, right? So I'll write the bigger one on both sides. Yeah? Then I can see this is perfect now, but this is not. Whatever is left is what we call the balance carry down. Is that not it? So this will be 6, 13, 7, 3, 7, 6, 13, 7, 6, 1. Is that it?
Yeah,
1, 6, 6, 6.
Yeah.
Okay. They will balance B as well. Obviously, 6,000 is the bigger one, right? When I add here, I'll get 6,000. When I add here, I'll get 3,000. So 6,000 is bigger. So I'll write the bigger one on both sides. Yeah? This is perfect. Are you okay? Can we move on? I can clean this, right? So here is what I tell people. If you find yourself comfortable with the memorandum method, okay, because the sale and purchase method is a victory. But truth be told, that method is derived from the memorandum method. Okay. So if you understand this, you understand the memorandum method, try and picture it like I will try and picture how we are doing the sale and purchase method. It will help you to easily get it. Because truth be told, the sale and purchase method is even simpler than this one. Because we will not need to prepare a goodwill account. Why so? It is so because remember that that method only applies when the partners do not want to keep goodwill in the books, correct? They do not want to keep goodwill in the books. The memorandum method establishes the goodwill and then writes the goodwill off. Right? That's what the memorandum method does. It establishes the goodwill by passing the debit entries and crediting the partners, and then later writes the goodwill off by crediting the goodwill and debiting the partners. Right? The purchase and sale method does not even worry itself with creating the goodwill account. So the purchase and sale method does what you call the net impact. So what the purchase and sale method does is it tries to do these entries only, and it does a 5,000 that is hidden, but I'll explain how it's done, right? So that method does not bother itself with the preparation of the Google account. That's the first point you need to remember. It will only prepare the partner's capital account. Second point, it will not record the full amount of the goodwill. It will only record the net impact. And so what we'll have to do is that we'll have to do some arithmetic and establish what the impact of the change in goodwill will be on each party. And once we establish it, it is only the impact that we will use to do the entry. Are you on the same page? Okay, let me say it again. So we just finished with the memorandum method. The memorandum method will open the goodwill account and establish the goodwill or bring the goodwill into the books by debiting goodwill, crediting partners' capital. goodwill has been brought into the books. Correct? Then now they say, okay, partners say they don't want to keep the goodwill, so let's write it off. Then he will now credit goodwill to write it off and debit the capital account. Okay? So he goes through like a two-step approach before he's done. The purchase and sale method says that, but if the partners do not want to keep the goodwill in the book, why open the goodwill account in the first place? Because you end up writing it off anyway. So don't open it. So that's their first step. They will not even open the goodwill account at all. They will go straight to the capital account. But then they say, okay, we also know that the capital account must only take an impact of the net effect. I.e., let's establish the goodwill that you must pay the two of us, and you pay us, and you move on, life moves on. Let's not complicate things. Okay? So all we need to do is to establish the goodwill that needs to be paid to the two partners that they must share. There was a net impact. That's all. Okay? That's what we are going to do. So I will try and keep the goodwill account. Let me. So, first of all, we start by saying that partners, right? So there is A and there is B. Right? Then maybe C, right? To start with C, we will not get anything. What is the current ratio? Their profit and loss sharing ratio. 1:2. So that's 1/3, 2/3. Right? So then they establish the goodwill of 10,000. You know the goodwill is 10,000. So they then say, okay, if these guys are to share the current goodwill, A will get 3, 3, 3, 3. And B will get 6, 6, 6, 7. Are we okay up to this point? Alright. Then they go on and say, okay, but when we admit the new partner on board, this guy gets nothing at the start. Here he gets nothing, right? Because we said when we establish the goodwill, it is the existing partners that benefit from it. They must benefit before the new guy comes. So that's what we have done so far. Now, after establishing the goodwill and sharing between the existing partners, the new goodwill. The new goodwill will be 1/6 of 10,000. But the goodwill is still 10,000, right? 1,666 or 1,667, or like this. And then 2/6 will be what? 3, 3, 3, 3. And then this guy will be 5,000. Okay? Alright. Now, here is where people get confused. All you need to do at this point, and I won't say why the confusion is so that you don't get yourself there. All you need to do at this point is find change in goodwill. Okay? Which is this and this, and I will explain why you must find a change. What's the difference? One, six, six, so 7, right? Or 6, 6. Okay, and this one? 3, 3, 2, 4, and this is 5,000. Okay. You will notice that I have not used negative and positives. I have just found a change. Okay. I would have said this minus this is positive. This minus this is positive. And 0 minus this is negative. Negative 5,000. But I have not used the signs, right? Because I don't want you to just look
I want you to understand why it is like that. So I'll explain rather. Okay? Alright. Now, what is happening here? Now, the last column, I'll say, what must we do? Right? Entry. The entry to pass. Okay. Now look at what's happening. Mr. A, at the beginning, had a goodwill of 3,333. Okay? With the admission of Mr. C, the goodwill that Mr. A is entitled to has come down to 1,600. Are you with me? If you are Mr. A, will you agree? Right. Before C came in, the goodwill you were entitled to is 3,000. Upon admission of Mr. C, your goodwill has gone down. Will you agree? No, I won't. The only reason I will agree is if they are willing to pay me the difference. I'll say, okay, give me the cash of the difference. The only way I will agree for you to reduce my goodwill from 3,300 up to 1,600 is if you are willing to pay me. Because I have created this value, which I must be getting, right? Now Mr. C wants to come in and take some of it. I said, no, then Mr. C, you must pay me before I will reduce my goodwill to this. Because remember, my reduction goes to his benefit. This guy's reduction goes to his benefit. So they must take it from him. He must be willing to pay it to them. Do you agree? Okay. But what will happen is that the partner will not receive the physical cash right now. Why? Why? Because remember I said goodwill is intangible. It is not realized. It is an expectation of future value that will be created. Okay? So we will not put the money in your hands right now. What we will rather do is that we will treat it as if you have brought an additional capital into the business. Does it make sense? So we will rather, instead of giving the money to you, put it into your pocket, we will rather increase the capital you have in the business. So for this, if you want to increase a partner's capital, will you pass a debit or a credit? A credit, because the capital account is a credit account. So if you want to increase the capital account, you must pass further credits. So for this, we will pass a credit entry in the capital account. For this, we will also pass a credit entry because we are increasing his capital instead of giving him the money. What about this guy? He must pay. Okay, but again, let's say he doesn't want to pay. What must we do? We must reduce his capital because remember I told you that the goodwill is a notion of future benefit. So the guy will not pay for it now. So what we'll do is we will reduce his capital to that extent. And to reduce a person's capital, what do? We pass a debit. Because the capital account is credit. If you want to increase it, credit it more so that it increases, right? If you want to reduce it, debit it so that it reduces. So we'll pass a debit here. Once you have done this table, you are done. Because all you are saying is that the purchase and sale method says, once you have done this table, take this number and pass a credit in the capital account. Take this number, pass a credit in the capital account. Take this number, pass a debit in the capital account. So credit, debit, and the debit, credit to balance. Do we follow? Now, the explanation again. This bit. Okay. So you get everything up to here. Right? You follow up to here. Alright. I'm saying that prior to the partner coming, partner A and B together had created goodwill to the tune of 10,000. So when they share among themselves, A is entitled to 3,333 and B is entitled to 6,667. Are we on the same page? Alright. Upon the admission of C, the profit and loss sharing ratio changes. And because of that change, the goodwill that A is entitled to is now only 1,667. whereas B's own is 3,333. And C, who proud to today did nothing for the firm, all of a sudden is getting 5,000 of the goodwill. A and B will not agree to this arrangement because their goodwill has reduced by 1,600 and 3,300 respectively. They will not agree. The only way they will agree to this reduction in the value they have created is if Mr. C is willing to pay them for it. And if Mr. C will not pay because Mr. C will argue that goodwill is a futuristic, it's a notional concept. There's no money we can see right now. So I'm not going to give you money for it. And they too, they'll say, okay, but I'm not going to agree that you reduce my goodwill. Then okay, fine. Then let's increase your capital to the amount of the reduction so that you are not made worse off. Well, the only way A and B are complaining is because they are being made worse off by the admission of C. And they don't want to be made worse off. So if they don't want to be made worse off, then their capital account should be credited to the extent of the amount that they are being made worse off. Does it help? Say B, he too must be credited. Ideally, he will argue that he must be given the cash. But, I mean, the firm will say that this goodwill we are talking about is intangible. It's not like some asset they can sell and give you the money. It's not there. It's inherent in the business. It's a value that we think is there because there's one lawyer who has a certain reputation. We are based in this Legon. The profit is for the benefit of the shareholders, of course, but they cannot get it until dividend is declared. Okay. The directors can make a proposal for the dividend to be declared, but converted to stated capital. So each shareholder is going to be given shares in proportion to the amount of dividend they would have received. Meaning stated capital is going to go up. Right? So the guy is going to get shares. It's no money. And then the stated capital will be credited. It's the same concept. Your capital is like stated capital, except that here is not company, it's partnership. Sorry? Yes. Look, so the entries. I'll come to the entries. So this table I have built is just my workings to establish the numbers. I'm now going to do the debit and credit. Okay. All right. So let's let me clean the goodwill account, because the goodwill account, like I said, under this method, we will not open the goodwill account anyway. Okay. So now let's see how the capital account will look like. So remember in our example, there was no opening balance on the capital account, right? Same example. And I said, under this method, the goodwill account will not be opened. So there will be nothing like debit goodwill, credit capital. We will not open goodwill account. Okay. So there will be only two entries that will be passed, i.e. the capital contribution by C, because C brought in capital 15,000. We're told that. So that one we have to pass that entry, i.e. debit bank, because money has come in 15,000, right? And credit what? C. So partner A, partner B, partner C. So let's say on the 31st of December, whatever date is this, bank. Okay? He brought in for 15,000. Is that not it? And then you debit bank. Like I'm saying, you don't need to do this, right? But the examiner doesn't need this from for anything. Debit bank 15,000 being capital. capital from C. Right? You agree with this? Debit bound, credit capital. This entry will do. But the rest of the entry is here. Which is all you need now is this. Okay. So we are saying that for Mr. A, we must credit him. That's analysis we did. So we'll credit him with 31st December. And the credit will be, the description will be goodwill. What's the English? Right? How much? 1666. And then Mr. B is what? 3324. This was 34, sorry. Yeah? Mr. C must take what? A debit. How much? 5,000. That's it. Yeah. The rest is balance block. Okay. So the rest is to balance it. Right? So what do? We balance each column, right? So leave enough space. You don't know where the balance carried out will be, so just make sure you leave enough space before you do your quota, right? So let's balance A with A. I can see there's nothing here, right? So the bigger, of course, was 1666. Put the same thing here, 1666. So to make this balance, to be balance carried out, right? How much? 1666. The same applies. This is the bigger one, right? So 3334. 3334. So we make this balance. This will be the balance carried on 3334. Yeah. Here is 15,000. It's the bigger one. There's only 5,000 here, so I'll put the 15,000 on both sides. Right? To make this become 15,000, I need how much here? 10,000. Right? Every balance carried out must be what? So this is what? 1666. This is 3334. And this is 10,000. It is the same as the application. Like see, we've done this without the need to do the goodwill account. Because the goodwill account, the partners that they will not keep it in the books anyway. It is being written off anyway. So this approach says, why bother to open the goodwill account? Don't pay your thing, you get your numbers, pass the English like that. Yeah? So this, the good thing is that this is the fixed capital approach. This is the fixed capital approach. And the good news is that irrespective of whether it is fixed or capital, it won't change. Because with fluctuating, all you do is this would have been capital, that you would have had the current account issues and everything in this same account. But the arithmetic and everything does not change. Fixed, this is have a capital account separate from a current account. And items of current account should go into current account. Capital should then be this, the capital, the goodwill. Fluctuating says, put everything together, call it capital account. You don't mind. Arithmetic, simple. Are we okay? Now let's turn to the questions that senior put on their page. There's a past question, 2017. Let's have it 2017. B, D, and S are in partnership, running their law firm in the Cape Coast municipality. They are well known for their expertise in criminal law practice. Their capital and current account balances as at 31st December 2016 are shown below. So he gives us two columns, capital and then current account balances. B and D. Capital account is 100,000, current account is 25,000. And then S. Capital account is 80,000 and current account is 12,000. I begin to ask myself, why did he put the capital account of B and D together? Let's go. We'll find out. During the year under review, they made drawings in the following manner. BD, so BD is one person. Okay. So when I started, I thought B was one person and D was another person and S was another person. So interesting, this is how sometimes they can confuse us. So BD is an individual and S is an individual. So they are just two partners. Okay. So during the year, BD made drawings of 40,000 and S made drawings of 26,000 during the year. Now the drawings have been catered for in their respective current accounts. The terms of the partnership arrangement are as follows. 1. Interest on capital will be 7% per annum, while that on drawing will be 15% per annum. For the year 2016, S was tasked to do extra work and was to be paid a monthly salary of 6,000. Profit and losses are to be shared as follows: 70% for BD and 30% for Mr. S or Miss S. Net profit before considering the above for the year ended 31st December 2016 was 280,000. On 1st January 2017, they decided to admit Mr. Halifax on the following terms. Mr. Halifax to contribute 120,000 as his capital. They are to share profit and losses in the ratio 3:2:2 for BD, for S, and for Halifax, respectively. A goodwill of 70,000 is to be raised for the purpose of the admission. However, no goodwill is to be maintained in the books. Required. Prepare the partnership profit and loss appropriation account for the year ended 31st December 2016. And B. Prepare the goodwill account. And C. Prepare the partner's current account. Now, what comes to your mind after looking at the requirement of the question as far as the ended 31st December 2016? And let me also say this, right? Because sometimes we may not get a question, so I will not come back to it. It's also possible that the partnership will admit a partner in the middle of the year. In this particular question, that's not the case, right? If you look at the question, they decided to admit Halifax, right? Is it Halifax?
Yeah.
Halifax is being admitted 1st January 2017, right? That's like a perfect world, but it's not so perfect like that in the world, right? We will admit partners in the middle of the year, and that's happening. When that happens, he would have given us the profit they made up to the point that that partner was being admitted. That is the profit we will use. Because the existing partners must share in the profit that has been made up to the point where the new partner is going to be admitted. And after they have finished sharing, then the new partner can join. Then they continue from there. Then at the end of the year, the profit they will make for the rest of the year will be shared between the three of them. So we need to bear that in mind. Let's go. We start with what? Yes, I think the currency side. So we start with profit for the what? For the year. Profit, net profit before appropriation, right? Net profit before appropriation. How much? He says, during the year under review, they made drawings. Okay, the drawings, the terms of the partnership is this. He gave us the profit somewhere. I remember seeing it. Profit and losses are to be shared in this ratio. The net profit before considering the above for the year ended 31st December 2016 was 280,000. Do we have that? So the net profit is 280,000. So this number was obtained from preparing the profit and loss account. Okay, we already established this one, and this is where we'll start from. Now, before we begin to appropriate, we need to make sure that we have put all the income together, right? And we know this is not the only income for the firm, because partners have made some drawings, and the firm will charge the interest on that drawings. That interest on drawing is part of the income of the firm that needs to be appropriated. So let's go and do the workings for the interest on drawings and come and add it, right? So normally I'll leave like 2 blank pages where I'll have my workings, right? And then I'll say interest on drawings. Okay, so who and who withdrew money? BD withdrew 40,000. Okay, now according to the partnership agreement, what is the rate of interest on drawings? How much do they charge?
15%.
10% per annum. 15%. So 15% per annum. Were we told when the drawings were made? I mean, the exact date. Did the question tell us the exact date the drawings were made? No? Okay. So if we are not told, the assumption is it was made at the beginning of the year. We don't have any basis to say it wasn't, right? What do you get? That would be 6,000 or 4,000 plus 2,000, 6,000. Yeah? Do you get that? 6,000. And then Mr. S. Did Mr. S also withdraw any money? How much? 26,000. Also same interest, 15%. So that's 2613. That's 3,900. So sometimes you need to, because of time, you need to have some quick ways of doing this without a calculator. So, okay. I should forget about that. Okay. We say we will use our calculator. I think to be safer, let's do that. But I'll encourage all of us to get a calculator now and start using it to practice. Get familiar with your calculator. In fact, that can be a key factor to success. Don't go into the exams room with a calculator you are not familiar with. Please, I beg you. You start looking for things on the calculator, that then becomes an exams. Your time is going. So, we say add what? Add interest on drawings. BD 6,000. S 3,900. 9,900. 289. 900. Are we on the same page? Should I go over? Okay. So, remember that in a partnership, we say that the profit of the partnership firm has to be shared amongst the partners. Okay. I think the question is, what is profit? That's what we all need to be on that same page. What is profit? What is the profit properly so called as far as the partnership firm is concerned? Is it just the profit from the income statement, or there is more to it? And the answer is there is more to it. Because apart from the profit from the income statement, there are other income that the firm has in a bank account, in a treasury bill or something, and would have earned an interest, which would have been part of the firm's income. The firm was denied that opportunity because the partner came to withdraw the money. So we will charge the partner an interest. So that interest should form part of the total income of the partnership firm. Are we together? That is why we say that the profit to be appropriated or the profit to be shared amongst the partners is not just the 280,000 profit that is coming from the income statement. We need to add to that 280,000 whatever interest that the firm is earning as a result of the interest it is charging partners for the drawings they have made. Okay? We're told in the question that BD during the year withdrew 40,000. We're also told that S withdrew 26,000. According to the partnership deed, the partners are to be charged an interest of 15% per annum on any amount they withdraw. So what did we do? We calculated that 15% on the 40,000 for each of the partners to establish the amount they withdrew. Then we say that this amount we have calculated is an income to the firm. Okay, so that income has to be added to the profit that the firm has made before we start to talk of sharing anything. Okay, so now we've added those two interests we calculated to the profit and have established a new profit of 289,900. Are we together? Okay. So now we can begin sharing. But again, yes. If the person has not indicated profit on interest on drawings, yes, then we don't have to bother. We don't have to bother because, but okay, yes, we don't have to bother. You don't have to bother if the person did not say there's interest on drawings, because the partners may agree. Yeah, you can withdraw, but I won't charge you interest on it. If that's what the partnership team says, that's what it is. Yep. I said I paused because the same is not true with interest on capital. But when the with interest on capital unless the partners have categorically stated that there shall be no interest. The Partnership Act says that in the event they do not say any additional capital attracts an interest of 5% per annum. So, no, for drawn expense, because the law says that no partner should be paid salary for working for the partnership firm. So when we pay you salary, it is not salary properly so called. It is an appropriation of profit that we are marking as salaries. Okay, so that's why we bring that salary here. Okay, so I'm saying that now the sharing of profit for partners is in 2 steps. What we have agreed that each person will take plus a share of the residual profit, which will always be done in the profit and loss sharing ratio. So if we agree that you take a salary of 100,000, let's give it to you. If we say we will give you interest on your capital, let's give it to you. When we finish giving these things, whatever is left, we will share in the profit and loss sharing ratio. Are we together? Okay. So now let's start. What are the things that we need to take out? We have to calculate that as well, right?
You don't have to.
You don't have salary. There is. I think there is. I read somewhere.
Yes.
I think so.
Yeah.
Oh, yeah. You did that. Anyway, we'll get to. So let's calculate our interest on capital. Okay. Interest on capital. We have BD. So the interest is 7%, right? 7%, and the capital is 100,000. So that's 7,000. What about S? Of 80,000. 5,600. Are we together? No, not yet. So remember, Halifax is being admitted on the 1st of January 2017. What we are doing is basically for 2016. January. So the dates, like I said, always be mindful of the dates. Okay. Okay.
Mr. Ahulu,
Hello.
I can see salary there.
You can see salary, yeah.
What?
We were just having a bit of discussion whether there's salary or not. Which II. So II says for the 2016, for the year 2016, S was tasked to do extra work and was to be paid a monthly salary of 6,000. So there's salary. So we'll come to that. Yeah. So thanks for pointing it out. So we've done the calculation for interest on capital. So let's do it. So we'll say now appropriation, right? So interest on capital. And we'll have B and S. BD, we've already done the calculation. We have 7,000. And S, we have what? 5,600. Making a total of 12,600 or 12,600, is it? And then somebody is to be paid salary. Who? S.
S, yeah.
S is paid salary. How much?
6,000.
That's where you have to be careful. How much is the salary? Check again.
Monthly 6,000, so times 12.
Exactly. Monthly 6,000, so times 12, right? So what I will do here, I'll say salary. S. 6,000 times 12. 72,000, right? So these are the small things that they will use to beat us. So now we are progression, so we'll take it out. So salaries is 72,000, right? Great. What else? We've dealt with point 1, we've dealt with point 2. Point 3 says profit and loss is to be shared in this ratio. Net profit is 280,000. Admission on 1st January on 100,000 goes into 20,000. Yeah. Share profit and loss in this ratio. Alright. That's about it here. So what do? We take this and this out of this. Right? So what we have this profit. The firm made interest on drawings to get a total of this. Then they gave to the partners this in terms of interest on capital. They paid them this. And then they paid salary to a partner of this. So when you take these two out of this, you get the residual profit that is left, that is to be shared in the profit and loss sharing ratio. Yeah? 205,300. Yeah? Okay. Then I will continue. I'll clean the top here, right? The header. Yeah? Just the header. I should clean the working. Somebody says I should clean the working. Are we okay? Alright. Right? We have BDS. We're sharing profit in what ratio? BD is getting what? Okay, no. So the existing partner before the admission. 70-30. So this is 70%. And this is 30%. So this amount is going to be shared in the ratio 7:3. So 70% of 205,300. And then 30% of 205,300. What do we get? One, 4, 3, 7, 1, 0. And the second one? 61597. Yes. This one. Okay. So this one, 50 marks. Sorry? We haven't finished. But like up to this point, it's 15 marks. So you can imagine. By the time you are done with this, you already have your 25. You just have to go and get your LPM sorted, and then you are done. So there are 3 requirements for this question. The appropriation account, which is what we've done, which is worth 15 marks, right? And then there is a goodwill account, which is 5 marks. In fact, that one, like 2 minutes, you get your 5 marks. And then there's the prepare the partner's current account, another 5 marks. So you can get 50 about 25 marks.
The appropriation account, which is worth 15 marks. And then there is a goodwill account, which is 5 marks. That's what I like to do. And then there's the prepare the partner's current account.
Okay. Can I claim so that we can move on to the requirements 2? Yeah?
Okay. Can I claim so that we can move on to the requirements 2? Yeah?
Requirement 2 says goodwill. A goodwill account. So I'm just going to assume that we've written the partnership firms or I should still write it. BD. And so in this case, you have to be careful, right? You will not prepare 2 goodwill accounts. So the firm may not be PDNS. Remember, Halifax was limited, right? And what did they agree to do? Are they going to keep goodwill in the books? They will not keep goodwill in the books. You have to be so